Have you contributed to a Roth IRA for 2020? According to IRAhelp.com, if you have not, you still have time. So very basic blocking and tackling type of planning. Contribute to a Roth IRA, max it out. The deadline for making a prior year contribution is your tax filing deadline. So April 15th, 2021, not including any extensions you might have. So if you maxed out your Roth, if you need deductions, have you maxed out your traditional IRA? So very important for you to call us if you need help. Now, there's something called a reverse rollover. When we think of rollovers, we normally think of moving money from a 401k to an IRA. But sometimes it makes sense to do a reverse rollover. So when does it make sense? According to Ian Berger of IRAhelp.com, a reverse rollover might make sense if you work past age 72, if you leave your job in the year you reach age 55 or later, and sometimes you can receive a plan payout without being hit with the 10% early withdrawal penalty. With a traditional IRA, you usually have to wait till 59.5. Number 3, depending on your state's laws, you may be better protected from creditors if your retirement savings are in a company plan rather than in an IRA. IRAs have creditor protection up to, I believe, about $1.25 million, where 401ks have unlimited creditor protection. While you can take a loan from your workplace plan, loans are not available from your IRA. And if you're considering converting a traditional non-deductible IRA to a Roth, if a backdoor Roth option is sometimes better. But there are also reasons to keep your money in an IRA. You can access your IRA savings at any time for any reason. By contrast, plan payouts can be only made upon certain events, leaving your job, becoming disabled, or incurring a financial hardship. My biggest reason to do a rollover from 401k to IRA is freedom of choice. You typically have more investment options for your IRA funds. In a plan, you are limited to the investment options allowed by the plan. I want members of both parties to change this. I think they should allow in every 401k in America a self-directed option. Not cost anything, would actually help benefit financial planning firms. Now, typically with a self-directed option, you have to pay a little more in a fee because you usually have a financial planner to help you, guide you, but you have options. So you can invest in individual stocks if you want. You can't do that in a normal 401k. Several of the exceptions to the 10% penalty, higher education expenses, first-time home purchase exceptions, are available for IRAs, but not available for 401ks. So sometimes you want to do a reverse rollover, and sometimes you do not. Now, someone who does a 60-day rollover as opposed to a direct transfer, this also from IRAhelp.com, not only has to worry about completing the rollover within 60 days, but you also must comply with the once per year rollover rule. You can only do one rollover per year. You can do an unlimited amount of custodial transfers, but only one rollover per year. That rule says that you can't roll over an IRA distribution received within 12 months of a prior distribution that was rolled over. Since you have two IRA distributions occurring within 12 months, you can only roll over one of the two distributions. So remember the once per year rollover rule. A lot of people forget that. So give us a call, folks, today, and you get the new book, The New Retirement Savings Time Bomb. Like I have said, inflation is here. And if you want to make something worth less, flood the market. I can always think of the Thai Beanie Baby craze. They were very sought after, and then they were overproduced, and then all of a sudden, they're kind of worthless. You can get them on eBay for like $3, $4. Give them all my kids. My mother, she thought the Beanie Baby craze was the one that was going to make her rich. And she bought all these Beanie Babies, and the good thing is I have something to remind me of my beautiful mother, and we gave them to the kids, and they love them, but they're really worthless. Occasionally you get one of these rare ones that are worth like $50. But if you want to make something worth less, what do? You flood the market. You have excess supply. That's what's going to happen to the dollar, and it's already happening. The Federal Reserve is primarily focused on unemployment and not inflation, according to numerous officials and Jerome Powell. They are willing to let the economy run hot. That means tolerating higher inflation for some period while they try to reach what they consider to be full employment. However, as is so often the case, according to Malden Economics, the left hand is not working with the right hand. The bond market has not been happy the past few weeks, and some of the reasons we've been seeing the market correct a little bit is because last week's Treasury auctions were ugly. The yield to cover was the worst in history. So what do? Well, we are definitely at bloated, overvalued market levels. And if that concerns you, you can feel free to call us at 800-321-0710. Ask me any questions about that, or you get your free portfolio stress test at 888-988-JOSH. Calls today. Get the free portfolio stress test. If you're concerned about the economic uncertainty of the moment, call us now. 800-321-0710. We'll be back after these messages. Okay, we're back. This is Josh Jalinski, the Financial Quarterback, and we're going to the phone lines at 800-321-0710. We have Dr. Gene. Go ahead, hey. Dr. Gene.
Hi, it's Dr. Gene. I'm 80 years old. I'm married. Okay. I have an antique car collection and literature worth very rare stuff worth $200,000. Okay, that's a round figure. I want to put it in a trust. If I could, can I put it in a trust that would bypass estate taxes and go directly to the children, the grandkids, if they're the beneficiary?
Yes. If it's done properly, depends on how much you're worth. Now, trusts may pay an income tax. You generally avoid trusts. It depends on how much you're worth. So let's say you can gift up to a certain amount, like let's say about $12 million per spouse. So you could gift up to 24. You could gift up to $24 million without estate taxes. The reason you would gift to a trust is generally the avoidance of estate tax if you're above a certain amount.
Okay.
Or if you want some measure of control in the grave, or if you want, let's say they lower the estate tax threshold from the current to the old. A lot of Democrats have said they want to lower it to about $6 million per couple. So if you're worth over $6 million. So I would say you would definitely want to do a trust if you're worth about over $3 million, because they're saying, hey, the $3 million for your spouse, $3 million for you. That's kind of what they're signaling.
Yeah.
And
how about the state tax? That's federal.
Yeah, there's also state tax. You got to watch that. Yeah.
Yeah, that's what I'm concerned about. Will the trust help me facilitate me avoiding this state tax?
Yeah, it may. I mean, trusts are primarily for the protection of your money against creditors, predators, in-laws, and outlaws. Creditors, meaning from your heirs being sued because they inherited all this money. Predators, meaning the government. In-laws, meaning, if somebody you love marries somebody and then they get the money, and even if you love them, you just want the money to go to your blood. Outlaws, meaning protecting your money from that in-law who turns to a bad in-law. But generally speaking, income tax planning, passing money tax-free is best done within a Roth or life insurance, or in stocks that pass with a step-up in gain. But you could definitely have car collections in trust, things like that.
What kind of car? Is it whole life insurance?
Well, it depends on how it's structured. There's good whole life, there's bad whole life. You want to call us and we'll help you with structuring. There's generally I like what has a fixed cost of insurance where they don't rise your premium every year and where the money grows tax deferred. Well, any life insurance cash value grows tax deferred and can be pulled out tax free as long as you follow Internal Revenue Code 7702. And if you call us today for the free review as a thank you, we will give you the book, The New Retirement Savings Time Bomb by Ed Slott. So call us now. Okay? Any other follow-up?
You at the 998 number or?
It's not. Okay, it's 888-988-JOSH. 888-988-JOSH.
We'll call. Thank you very much.
They're there right now. And the other reason you would put cars in a trust would be, let's say you want all children equally to be the recipient of it and the profits, but there's one kid that really gets the car business. And you wouldn't want to go to one kid exclusively because then they might sell it at a loss. You name the kid who really knows the car business, the trustee, but you have all children equally as the beneficiary. That's something you could look at too. So if you want to share equal love, but you don't want maybe the kids who don't know as much, it's like, you know, when a kid takes over a business, you may want all kids to equally share in the sale of the business, but there's one kid who really enjoyed the family-run business. So I hope that helps you, Dr. Jean.
You gave me some other things to consider, yes, about the equal sharing, but then who's the trustee going to manage that for the equal shares?
Like you're a car guy, right? I mean, how many kids you have? How many kids you have?
I have 2 children, but 3 grandkids.
Okay, so probably one of them cares really about the cars.
Yes, that's exactly right.
And you make that kid the trustee or something, but he has to share equally, you know.
I like that.
So he's not going to sell at a loss just to get money because he really appreciates the value of the car. It's like I inherited my mother's worthless Department 56 collection. It was worth a lot to me, but I was the only kid who cared about it. So
what kind of collection?
It was Department 56, those little Christmas villages. I love putting those up every year.
Wow.
My mother thought that would be worth a lot of money. It really wasn't, but it's worth a lot in memories and love, and my kids get to appreciate it too. So
I see that.
You know, so some of these things are just like, you know, or maybe he really wants that car as part of an inheritance. You just give the car to him, and you back out that value to the other child. You know, so you leave 55% of one of the IRAs to one of the kid who doesn't collect the car, 60%. You know, so you could do stuff like that. A lot of people aren't creative with their estate planning, but they need to be. And we'll help you guide you through that at 888-988-JOSH. Okay, next up we have Rich, who has a question on contributing to his Roth. Go ahead, Rich.
Hi, Josh. Thanks for taking my call. I have a few questions on the Roth, if you don't mind.
Sure.
One being, I retired last year at 62, and I maxed out on that in those few months in the contributions to the 401k. Now, can I still contribute for last year for the for the Roth, or is that being contributed to the 401k? I can't.
Is it a Roth 401 or a Roth IRA?
It was a 401k, a regular 401k in the job.
You have until April 15th to do a Roth IRA, and our people can help you at 888-988-JOSH set that up.
No, I know that. What I'm wondering is, being I did contribute to
you mean the Roth? I'm not understanding the question. I'm not understanding the question. Are you asking, can you contribute to a Roth 401k from last year or a Roth IRA from last year?
I'm asking if, being I maxed out on a 401k, can I also contribute to the Roth for last year, a Roth, as opposed to a 401k in the job? You
can if you have income below a certain amount.
Okay, the income threshold. Okay, so
yeah, there's an income threshold.
Okay. Number two, being I'm 62 now, how far forward can you keep contributing to the Roth while you're retired?
Well, what's nice, Roth conversions, there is no age limit. Roth IRAs now, there is no age limit so long as you have wages. So what some people do is they get a part-time job when they're retired. They work at Home Depot, they work at Starbucks, just to get out of their house. And then they can do a Roth IRA. But to do a Roth IRA, you need wages, or your spouse needs wages. If your spouse has wages and you don't, you can do a Roth IRA. If you work at a job that has a Roth 401k, you can do a Roth 401k. If you don't have a job and your spouse doesn't have a job because you're both retired, you can do a Roth conversion, or you can do life insurance. Those are the two best areas if you do not have wages and your spouse doesn't have wages. Or you look at conversion.
With the Roth conversion, what's the max you can convert annually?
Oh, you can do unlimited.
Okay.
You can convert $10,000 a year. Like there was a woman who called earlier, Claudia, she didn't pay any taxes. That didn't mean she didn't pay any taxes. It meant her deductions probably offset her income. So she didn't owe any tax on the conversion. She's probably lower income. I think she was around 45 grand of income or less. That's a powerful reason to do a Roth if you have lower income and you're only maybe collecting Social Security and maybe living off 10 or 20 grand of your assets. It's good if you're struggling. It's good if you don't have as much income, and it's good if you have a lot of income and a lot of assets because it lowers your assets for estate tax purposes.
Right. So with the conversion max, I mean, there is an annual threshold there also. I mean, you can contribute $1 million.
No, you could convert $1 million. You could convert $20 million.
Oh, really?
The conversion is unlimited. The contributory Roth is limited.
Okay.
The Roth 401k is limited to $19,500 if you're 49 or under. If you're 50 or older, it's $26,000. If you're doing a Roth IRA, the max limit is $6,000. And then you have $7,000 if you're 50 and older. But a conversion, there is an unlimited income threshold. Does that make sense?
It does. Yeah. Okay. Well, that's good to know. I didn't know there was. I thought there was a threshold for the conversion, but there isn't. Okay.
And also, what's nice, if you have higher income or you have no income, you could do life insurance. That also benefits. You might say, why life insurance? Well, let's say you have 60% stock, 40% bond portfolio. Well, the bonds will do similarly to life insurance. And then you'll get the death benefit, the long-term care benefit, potentially all those various, double duty dollars, as Ed Salt was calling. And so let's say you have a portfolio of $1 million, 600,000 stock, 400,000 bonds, or you have 200,000, 120 stock, 80 bonds. You can take that 80 grand that's in bonds, similar risk profile as life insurance, but you get these other benefits. So your Roths would hold your stocks, your life insurance would sort of be the bond alternative. Does that make sense?
Okay. It does.
And then that would be maximally, that would be the best thing from a tax perspective if you want the money to go tax-free. Have your high growth assets in the Roth. So hope that helps you, folks. We'll take a short break. And when we return, we'll be back with more of your questions at 800-321-0710. 800-321-0710. We'll be back after these messages.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jalinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jalinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jalinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation.
Advisory services offered through Wealth Quarterback LLC.